We're going to begin in just a couple minutes. I want to cover just a couple things. For those of you who have joined us before, these should all be fairly routine and nothing new that I know of, but we will have some poll questions as we normally do. For those, especially those that are getting CPE credit, please complete those. And of course, we ask that everyone who attends complete the poll questions, because the information is important to us and to the rest of the audience. So 3 poll questions. If you have questions, you can submit them in the question feature in your control panel as normal. And again, if we can't address questions, we did get some questions pre-webinar. We will address all of them. We'll follow up on an individual basis. We may publish, as we've done sometimes in the past, publish a Q&A. We'll see how that goes based on the level of questions we get and the number of questions we get. You can download the presentation slides in your handout section, and we will, as usual, record the webinar, and then at the end of the webinar there will be a survey that we'll launch. So with that, I'm going to go ahead and welcome everybody and get started. We do have our normal disclaimer. You can review that in the handout. Honored today again to have Jim Brandenburg from our Milwaukee office join me in presenting today's webinar. Good morning, Jim. So thanks for jumping on. A little bit of a repeat of some things I just covered, but please take note of these items, and again, you can review those in the handout. So our agenda today, what we want to cover, we want to cover an overview of the bill. There is some IRS guidance to date. We'll provide you a list of significant guidance. There was actually something that came out yesterday. So the guidance keeps coming out. And of course, the IRS is now back at full strength in terms of their, the government being open again. So we should see more of that. And then we'll talk about some planning strategies, both at an individual level and at a business level. So with that, I'm going to turn it over to Jim here, and we'll cover these OBBBA topics. Jim?
Good. Thank you, Tom, and good morning, everyone. Thank you for joining us here. Tom, let's get to the next slide here. Just again, a brief overview of the OBBBA or OB3, as some call it. Again, after last year's election, just about a year ago, when they took control, they wanted to move ahead with the tax bill, as they did in President Trump's first term. A lot of debate. They wouldn't use the reconciliation process. That was the whole first part of this year. July 3rd is they did get the bill through Congress, and July 4th is when it was signed into law with it. Again, some significant changes for individual business. We'll cover those today. There are also change for some foreign changes and tax-exempt organizations that were out there. We're not going to cover those, but those were some other changes. And again, without having this bill going ahead, we'd be looking at something referred to as a tax cliff next year. Would have been significant higher taxes in some areas. Many taxpayers, practitioners were concerned with. Again, that did not happen because of the passing of the bill. So again, we're going to cover some of these provisions, but again, it's selected items. We're not necessarily going to cover everything in the bill. Next slide. Okay, the first area that we're going to look at is just individual tax rates. Again, a significant dollar impact in the bill, but no real change because we're going to continue with the current tax rates. Again, these were scheduled to expire at the end of this year and go back to what they were before, back in 2017. But with the passage of this bill, the rates continue on. Again, they're continuing to be indexed for inflation. Again, this is, again, applies for next year, but again, it's just a continuation of the current rates where we're at, no increase coming in, and this change is permanent. One item we just wanted to mention, Tom and I did, is this permanent. Again, it's permanent in the sense that they're not scheduled to expire. A future Congress or president could always pass a bill to change a provision, but tax changes are not easy to come by. There's a lot of rules they need to follow, many things to line up. And but anyway, they're permanent, and again, at least for the foreseeable future, not scheduled to expire or sunset. So just keep that in mind anytime you see permanent in here in any of the slides or you hear that. Next one is the standard deduction. Again, that was doubled by the TCJA back in 2017. Again, that's going to continue at the higher rates and index for inflation. Again, that's permanent. Next, again, the qualified business income deduction. Many of you may be familiar with the 20% deduction for businesses, either partnership or S Corp, or even in some cases a sole proprietor. Again, that's going to be made permanent. That would have been a significant increase had that not been extended. They made a couple changes with it. They will not go into those, but just and those are favorable mostly. Again, this is effective for 2026. Again, permanent change, again, helping small businesses that have that deduction. And we come to our first polling question here. I'll read it for us here. What individual tax change in OB3 are you most impacted by? So we got 5 choices here. The extension of the current income rate, tax rates we talked about, extension of the standard deduction, the 20% qualified business income deduction, the higher SALT deduction we'll talk about shortly of up to $40,000, or don't know. Got a number of responses coming in. We got almost most of the folks, so we'll close that off in a minute. Thank you for voting.
Okay. Well, I think it's a dead heat between extension of the current income tax rates and the higher SALT deduction. Which I agree with. The current income tax rate extension is a really big deal. Because had we gone back to the old rates, it would have been, and the brackets too, would have been quite a increase in tax.
So good, thank you for polling. We've got several more poll questions coming up later. Next one is the AMT. AMT, again, used to be an issue again before TCJ made the changes with it. They increased the exemption and also where that exemption phases out. The OB3 here, continue that. They reduce the exemption phase out where it starts a little bit with it and a phase out rate. We may see a few more folks in AMT. I don't think it's going to be as to the same level it was back in 2017 or before, but it's something to keep in mind starting in 25 and 26 with it. Again, that's a permanent change. Next with it, this is a sort of a new one. What they introduced is they used to have a separate adjustment for your itemized deductions, and what the Congress did this time was that they came up with a new adjustment on your itemized deductions. Again, this applies to taxpayers that are in the top rate, the 37% tax rate. And what really is going to happen, it's going to reduce the benefit of their itemized deductions, those that itemize, from 37 down to 35%. And the mechanics of it is they take 2/37 of those deductions and they have a limit there. But anyway, just be mindful of that. If you're in the top 37% bracket, those itemized deductions are only going to receive a 35% tax savings with it. Again, one thing to note, we'll talk about this later, that starts in 2026. It does not start for 2025. Next slide here is, as Tom mentioned before, this SALT deduction. Again, that was one of the more controversial items in the TCJA a number of years ago, and it still was probably the most controversial provision in the OB3. The state and local deduction had been at $10,000. It was back and forth in Congress, and both in the House and the Senate, all year. And what they finally landed on was a $40,000 deduction. They knew it was going to increase. They just weren't sure how much. But they have a phase down with it now, not a phase out, but it's going to go from $40,000 down to $10,000 once the taxpayer's income is over $500,000. So between $500,000 and $600,000, it phases down from $40,000 down to $10,000. Once you're above $600,000, it's capped at $10,000. And that's effective for the 2025 year. So again, those that are less than that level, they're going to get $40,000 for state and local taxes this year. One thing to note, this only runs through 2029, then Congress is going to have to look at this SALT level, this provision again. Next item that I just wanted to point out here, there was a lot of discussion with this. Many states, it started back when the TCJA put in that SALT limit of 10,000. Many states put in what they call a workaround, a pass-through entity, where the pass-through business could actually pay that state tax at the entity level. And a number of states put that in, and that was a way to kind of work around that $10,000 cap. Well, Congress had talked about maybe changing that in some manner, had a number of proposals that would have made it much more difficult to get through that. At the end, though, they did not adopt any of those changes. They kept in place what it is, so which I think is a good thing for many businesses, that they don't have to worry about that. So the pass-through entity election is still available going forward. And again, most states that have an income tax have adopted some form of pass-through entity tax there. Turn it over now to Tom with a discussion on some of the Section 529 plan changes.
Okay, a couple things here just to note for those of you who have 529 plans for maybe a child or grandchild. You know, these are positive things that keep expanding the utility of those funds. We're not covering the HSA. The HSA is another one. There were some small tweaks to expand the utility of HSA funds. So probably a lot of us going through open enrollment right now. So look at that. But for 529, a couple big things here. Qualified use of funds for K through 12, right? So a few years ago, we expanded the use of 529 plans for K-12. Now can include testing fees and tutoring and dual enrollment fees and educational therapy. So all good stuff. And then the amount of expense annually that you could pull from 529 for K-12 doubled, right? So these are both, you know, pay very specific attention to effective dates on all these things. We try to get those on the slides here, but you can see just in this little change, the effective dates are different for these different provisions. And then the last one was the qualified use for post-secondary students. Really expanded it to what's called post-secondary credentialing. So the CPA exam expenses or CPA exam review courses, as an example, but a lot of other you know, post-high school type programs, apprenticeship and things are, may be covered by 529 now. So you know, if we have a child or grandchild that doesn't go to college, it's possible that some of these programs may be covered and a qualified use of 529 money. As we know, a lot of these credits, this bill took a hard look at. The home energy credits basically are expiring at the end of the year, right? And the autos, for the autos, we've already passed that date. So if you acquired a vehicle, if you after September 30th, an electric vehicle, it probably doesn't qualify. But if you made a down payment on it before September 30th, take a look at that, because that still may meet the requirement. So, but these are some major changes to the credits. And then lastly, this is a big deal for those that are you know, have a sizable estate. This was made permanent, right? The estate and gift tax exemption. And so starting in 26, this bill increased the exemption to 15 million, and it's indexed for inflation after that. So 30 million for a married couple. So we already know what the exemption limits are for 25, but for 26, it jumps up to 15 million. And so this made this permanent, right? So remember, permanent is only until somebody decides to change the law, which you know, could happen in the future. But for now, we have to rely on what is permanent. So I think we got another poll question here, Jim. You want to read the question for the audience?
Yeah, we got two questions came up pretty quick here. Based on all these OBBBA individual tax changes for 2025, what do you think? Will you itemize deductions or use the standard deduction? Okay, we've got 4 choices. Let's say you itemized in 2024 and will itemize again in 25. Use the standard deduction in 24, but with some of these changes, you will use again in 25. Use the standard deduction in 24, but expect to itemize in 25, or you itemize in 24 and expect to use the standard deduction in 25. So 4 choices for you here. Just curious to see where folks stand with that.
Okay.
Everybody's almost voted here. I think we're just about set.
Yeah. I think the winner is the standard deduction is going to be consistent from year to year but a few expect to change. So thank you for your participation. So Jim, I think we're going to jump into one of your favorite topics, which was presidential campaign themes that made it into the tax bill. And maybe more questions than answers on some of these, but why don't you take us through those?
Okay, good. Thank you, Tom. Yes, again, the first section again was an extension that we covered on the TCJA. A lot of those ones that were passed and again needed to be extended or made permanent with it. Again, that was a foundation of the OB3 bill. But then last fall, when we had the 2024 campaign, there were a number of themes that came up that were introduced. In fact, and both parties actually did this, and those actually ended up in the bill here. So we're going to go through a number of those. The first one is this no tax on tips that came up. Again, it was popular among the voters and those impacted by that. It sounds good, but logistically, it's difficult to implement this. Again, what it's going to provide for is a deduction for those that receive tip income. But again, what they're first going to need to do, and the way the law was written, is they have to include that tip into income and then work through the limitations, and then they get a deduction out for the tips if they meet that. It's mostly going to be for employees, but there's also some ability for self-employed individuals to get that. The tip deduction is limited to $25,000, and they have a phase out here, for higher income levels. Next time here, what they did indicate, they came out in September, is some proposed regulations, but they talked about eligible occupations that can take this tip deduction with it. And they came up with a new code. They called it this Taxpayer Tip Occupation Code, TTOC. That's going to later be on the W-2s, actually starting next year. But they have these general categories. And what they're looking at is the type of occupations or employment that people have that traditionally have paid tips. They don't want to have ones that started here in 25 when this new deduction came out. They look back, from 24 before, ones that had paid tips before. Those are the type of occupations that are going to be eligible for this tip deduction. Next slide. Again, we talked about that. Again, the need to traditionally have that. They did provide that list. You can look through that list. What we did include, just for your reference, they did have proposed regulations came out on this tip deduction, and you can look through those. That's in the resource materials. One thing with the tip that's foundational, needs to be voluntary. By the payer is volunteering to give an amount to the worker with it. If there's a set service charge that's a fixed amount, that won't qualify for it. So if you're at a restaurant, it says 18 to 22% or whatever fixed gratuity, that won't qualify. But if it's a suggested tip and the customer can change that and put down 10% or 0 if they want, then the tip will qualify with it. So that's something a lot of the restaurant businesses or those that have tips on there are looking at. They're going to change their procedure with it. Again, there's a lot of examples in the regulations as to what will qualify for this tip deduction and what won't. So be mindful of that. Take a look at it. Needs to be a cash tip. A credit card also is covered as cash for that purpose. And again, if you share tips with other people at the restaurant or whatever place it is, that those can share, and those will qualify, get a tip deduction with it. Do need to get the Social Security number for those. If you have a married taxpayers that need to file a joint return to claim this deduction. One thing that's nice with this deduction is you don't have to itemize to get it. So it's a deduction for non-itemizers can take advantage of this. And one thing we'll talk about later too is the IRS indicated that the guidance for this, at least the reporting for employers, is going to start for 2026. and they had this notice 2025-62 that said there'll be no penalties for employers this year if they don't do the reporting for 25, but for 26 they will need to do that. What's going to happen is starting again for next year for 26 is, again, the tip income will include box 1 of the W-2, and then on box 12 of the W-2 there's going to be a code there, a TP, that will show how much your tip income you have. And they'll also indicate what your occupation is, one of those codes. So again, that's how they're going to know that, again, the tip is in your income, what the tip amount is, so that you can see if you can subtract it out. For 25, though, what the IRS has indicated is to use a reasonable method, and that's for the employers or for the employees on how to determine that deduction. Hopefully, they'll provide some more guidance on it. One thing to note, too, is that for the employees that do have a tip income, they are going to have to pay FICA tax on that tip. And again, the deduction they get is for income tax purposes. Again, that starts here for 25. Just realize that all the way back to the beginning of 25. And then it does cut off there, so Congress is going to have to deal with that. The next one, another one, a campaign theme, is no tax on overtime. Okay, that was with that. It sounds good, but actually to implement it and administer this is going to be difficult with it. It doesn't, you can't have overtime with tip income, just they do talk about that. What they do look at in the statute with it is it's overtime under this Fair Labor Standards Act back in 1938. That's going to be their guide for it. One thing to note, and this has been maybe some confusion with it, the overtime deduction relates to the excess that you get over the normal rate of pay that you get. So if you're getting time and a half for overtime, it's that extra half that you get. That's what's going to be eligible for the overtime deduction. Next slide here with it, Tom. The deduction is $25,000 at a joint return, $12,500 for other. There is a phase out with it for higher income. Again, as with the tip deduction, it's available for those that don't itemize. Again, there's a new Schedule 1A in the individual return that will collect these additional items. Again, if married, you need to file a joint return. You need to get your Social Security number so they can claim that. Again, as with the tip income, again, the overtime income, the gross is going to be in your box 1, and then the overtime amount will be in box 12, a different code for that, so they'll know what that overtime is, so they can take that subtraction. Again, those W-2 requirements start in 2026, and what they're supposed to use for 2025 is a reasonable method. And again, while the IRS issued proposed regulations for the tip deduction, they haven't done anything yet for the overtime. Hopefully they'll provide that soon, because there's a lot of folks that are wondering about this. And again, what you're supposed to use for 2025 is a reasonable method with it. There's not going to be a listing of occupations for overtime as there was for the tip income. Again, what they're going to look at is this Fair Labor Standards Act. But there's some other unusual situations. You know, if you've got a collective bargaining agreement, or if you're paying overtime, you know, the guidance is going to have to identify, you know, what overtime will be eligible for this deduction and what will not with it. So we're going to keep our eyes open for that. Hopefully that will come soon with it. That'll be vital to employers. And again, employers won't be penalized for that for 2025 for not providing that guidance, but for 26, they're going to have to make sure that they include that in the W-2 with it. So something to keep our eye on, but it's going to be, you know, widespread because it applies to so many different, you know, businesses and industries. The next campaign theme was no tax on car loan interest. And again, they put this in with the legislation. And again, what they're looking at is, you know, vehicles, mostly consumer type vehicles, or list some of the requirements for it. Is the cars that vehicles that qualify. The key thing with it is that it's made in the U.S. here. So the final assembly is made in the U.S. For the to be able to get this interest deduction. Next slide with it, Tom. That we're looking at is this deduction is up to $10,000. There is a phase out with it above $200,000 of gross income, but it's again a $10,000 deduction. And again, you don't have to itemize as you do for like your mortgage interest. You have to itemize to be able to take that. This deduction for the car loan interest, you don't have to itemize for it. There will be new reporting involved for it. Again, that's going to be the responsibility of, again, whoever provided the loan with it in this case. And it's going to be similar to, there's a Form 1098 that many may be familiar with that you get for your mortgage interest. You're going to get a similar type 1098. In fact, I think the draft of that form is out already, that will show how much interest you have on there. You need to report the VIN number of the new car on there. So and again, lenders are going to be charged with that reporting. Again, for 2025, they're going to give some sort of transition relief. In 2026, so they'll be required to do that. Again, this starts here in 25, again, back to the beginning of the year and runs through 2028. Again, Congress will have to look to extend that at that point. Next one is a senior deduction. Again, it's been a little unclear with it in that, you know, many have said in Congress that there's no tax on Social Security benefits. That's not actually what happened with it. Under the reconciliation rules, they weren't able to do that. So what Congress did is just give a senior deduction to those age 65 and older. They get a $6,000 deduction per person. And if their income is over $150,000, they'll phase out. But this is not an itemized deduction. Again, they'll get this in addition to their standard deduction to offset some of their Social Security benefits, but it's not an exclusion of the Social Security benefits. Again, that starts for the 2025 year and runs through 2028. The next one is a campaign theme is the Trump accounts that came up with Congress. And again, what this is, and again, some other countries actually have this. It's in addition to some of the college savings accounts that are out there, it's a new universal savings type account for children. It's more of akin to an IRA, but there's no earned income requirement. You can set the money in there. It's not like a Roth, it's like a regular IRA. Again, it's for these individuals, again, under age 18. That we new form that they file. Actually, that the contributions for start on this will start actually in 2026 with it. And there's some requirements there. There's no guidance that's come out yet with it, but it again will be a additional vehicle which children and parents or parents can have for children or grandchildren to save for them for a variety of things besides just for college, for a number of uses. And we'll watch for the guidance on that. One thing too is that for newborns after actually through 25 through 28 that are born, the government will actually put $1,000 seed money into those accounts. So that's one thing to be mindful of. And again, we'll watch for that IRS guidance.
Okay. By the way, for those of you who are into trivia, Form 4547 will report the Trump account activity going forward. So very interesting use of form numbers there. You might pick up on that. So thanks, Jim. That was great.
I think they came out with the number before they even came out with the draft form yet, because I don't even think the form is out yet. So
yeah, right. So a lot more to be on the Trump accounts. All of those campaign themes basically are additional deductions that really are sort of outside what we used to think about with, standard or with itemized deductions. So different phase outs, all those things. Interestingly, one of the things that you think about is $10,000 of car loan interest is a lot of interest, and the phase out's pretty low. So not sure too many people are going to get that, but let's jump into some of the business provisions. We're going to talk a lot about depreciation and also talk about some, some of the provisions that were rolled back with R&D and with interest deductibility, which I think in general, we really need to look at what the impact of all these things are before the year ends and see if we want to elect, bonus depreciation, how we want to deal with R&D expenses and things, that the unamortized piece. But some of those things really provide some planning activity or planning opportunities for us. So let's talk about bonus depreciation. 100% bonus depreciation deduction is restored. It had been 100%. It was, as we know, starting to phase down. Again, as Jim mentioned, in a lot of these provisions, you got to really pay attention to the effective date. So in this case, a property acquired after January 19, 2025, right? If it was acquired prior to that, it falls under the old rules. So you really got to look closely at property acquisitions that happened maybe late last year, early this year, and determine which bonus depreciation rules impact or which apply, right? Because you've also got binding contract rules, which you could look at and determine, well, gee, we paid for that property or that equipment prior to or made a deposit prior to 119 or 120.25. But in fact, once we look at the rules, we sort of peel back the onion. We think this qualifies for bonus because of the fact that the tax law would indicate that we really didn't actually acquire it until after 119.25. So there's a lot of nuance there. So take a close look at that. It'll obviously be very important in 25 since we have somewhat of a transition to the back to the 100% bonus. So it applies to newer used property, effective for 25 for property acquired, and this is permanent, right? There's no phase down anymore, so that's good. 179 was also somewhat of a welcome surprise. The deduction limit increased from $1,250,000 to 2.5. Phase out threshold raised to 4 million. So once you hit that 4 million, you start to phase out dollar for dollar to get to until you get to 6.5 million. This particular provision applies to property placed in service beginning after December 31, 2024. So different effective date, right? We don't have that January 19th date here. So again, permanent limitations. Look at, there are some situations where you would use bonus versus 179 and vice versa, right? So, but both of them are very positive for taxpayers making investments. Research expenditures, as you might remember, TCJA had a provision in it where starting, I think, in 2022, we started to have to capitalize research expenditures over 5 years, right? So we would amortize them down over 5 years. That provision was somewhat rescinded in this bill. And actually now we can go back and write off. There's, depending on the size of the business and what election you make, you can effectively write off that unamortized cost in 25 or in 25 and 26. And of course, for smaller businesses, which are defined as gross receipts under 31 million, you could go back and actually recoup those deductions by amending those prior year returns, right? What I would tell you is we've looked at this and there's a lot of complexities to making that decision to go back and amend. So, but there's lots of options here. The good news is going forward, we can write off those expenses for tax purposes. We no longer have to amortize them. That does not apply to international research, right? You're still on a 15-year amortization schedule for any foreign research that is incurred by the business. So, so all good stuff. And again, we can make some decisions here based on taxable income this year and next year, and maybe even what, for smaller businesses, what prior years look like as to whether or not we go back and amend those returns. So limitation on interest deduction. Again, remember that at some point, and I can't recall which year, we changed the formula on how much interest was deductible, right? When TCJA was passed, it was based on EBITDA, right? Which is this idea of adjusted taxable income was using an EBITDA formula, which allowed us to add back depreciation and amortization. And then at some point, we went to EBIT, which is to say we no longer added back depreciation and amortization to a base number. And so the formula is 30% times that base number. And because we weren't able to add back depreciation and amortization, we couldn't deduct as much interest. So we've seen clients accumulate some interest limitation carry forward. So the good news here is that effective, for tax years beginning after December 31, 24, we now have the formula of EBITDA again. So we should have more interest deductibility going forward. So this is all very positive, and that's a permanent change as well. A new provision in the tax law is qualified production property, right? So qualified production property is effectively a provision to encourage U.S. investment into production and manufacturing facilities. So instead of depreciating these facilities over 39 years, qualifying property under these new QPP rules will be allowed to be written off immediately, right? So we don't have a lot of details on QPP yet. There's a lot of questions. What does and doesn't qualify? What we are fairly confident in is it's only production facilities. So if we have a production facility that also includes a sales office or administration of the business, accounting and the executive suite, only the portion of that facility that is dealing with production will qualify, right? We also don't know, which a lot of clients do, is a lot of our clients will purchase and build facilities in a separate related LLC and rent it back to the operating business. We don't know, and frankly, we believe that those facilities would not qualify for as QPP. In other words, the operating business, we believe, has to own the facility. But again, we don't know for sure because the regulations, the guidance from the IRS has not yet come out. But this is a question that many practitioners have. And then, of course, we get into a lot of these aggregation rules that are in the tax code and whether or not those might apply to allow that arrangement to qualify under these QPP rules. So significant tax incentive, it is temporary, right? This does expire. So pay attention to the placed in service dates. So as long as construction commenced after, on or after Inauguration Day, and it starts before January 1 of 29 and finishes before January 1 of 31, and it meets all the other criteria, which we're waiting to get more guidance on, it should qualify. So the other issue that we probably need more guidance on is, whether a major renovation of an existing building would also potentially qualify as QPP. So a lot to be determined here, waiting for more guidance. The IRS's priority guidance plan came out, and they were, all of these provisions were high on their priority list to get guidance out. So I know they're working hard on it. A couple other interesting things in the bill. Qualified small business stock is a provision that has really gained a lot of interest since the first Trump bill, the Tax Cuts and Jobs Act, really because the C corporation tax rate was reduced. This is an interesting, if not intriguing, provision business owners and investors should understand. It was enhanced in this bill, right? So it's C corporation stock, right? Original issue stock. We can't get into all the details of this today, but I'll tell you what the enhancements were. So if stock is owned 3 or 4 years, you can get a partial exclusion of the capital gain from the sale of that stock. We've always had, for stock that was acquired after sometime in 2010, this 100% gain exclusion. So that continues, but this bill added partial exclusion for 3-year or 4-year hold on stock. The gain exclusion increased from 10 million to 15 million per shareholder if the stock was original issue stock in a qualified trader business. Okay, and then finally the asset base, right? So what is a qualified small business increased from 50 million to 75 million. There's a lot more to this to make those determinations, but it's a very powerful provision for those that qualify. So these enhanced tax benefits, they exist, and they could create opportunities for not new businesses, just new business, but existing businesses. So if you are operating as an S corp or a partnership, or even a C corporation that doesn't meet these criteria, there are tax efficient ways to convert, but it has to be in the right circumstances, and there's more to it than just the tax benefits of this. So something to look at. It's a very intriguing provision. The new provisions, they are effective after July 4th, after the day the bill was signed. So review your existing structure. Consider this as another tool in the toolbox to think about, the long-term benefits and the type of entity that you should be. Qualified opportunity zones is something that was introduced in the first Trump bill. We're happy with the government is pleased with that new provision, that new concept, and they've enhanced it and made it permanent. So current QOZ rules, as we know, expire at the end of next year, right? So any deferred gain that investors invested in a QOZ, they're going to have to pay tax on that next year, right? So the new provisions of QOZ, they take effect January 1 of 2027. And so the current provisions allow taxpayers to defer gains into a QOZ and realize some step up in basis to reduce the amount of taxable gain. Depends on how long ago they invested in that QOZ. So the new provisions are going to create a rolling 10-year QOZ designation, and those will be released July 1 of next year. So we'll know on July 1 what the census tracts that are QOZs for the 2027 10-year rolling period will be. So investors are going to be able to defer gain, capital gain, or any gain into the QOZ, and they get a 5-year deferral on that gain. So eventually you'll pay tax on that deferred gain, and you'll get a 10% basis step up, which will reduce the tax on that gain. After 10 years, which is consistent with the current program, you're eligible for a gain exclusion on the sale of your interest, right? So you get a exclusion from the gain. So the new law also introduced this qualified rural opportunity fund, which is really for rural areas, more rural areas, and those are defined in the bill. More benefit there, a 30% basis step up, and after 5 years, right? So you pay tax on a lesser gain. So again, investment in these held a minimum of 10 years provides a gain exclusion. So you got to look at the quality of investment, but this is a really interesting tax benefit. Okay, I think we got another poll question here, Jim. So if you want to read that.
Thank you, Tom. Our next polling question here. This is again for businesses. Which item impacted your business most significantly in 2025? We've got these OBBBA tax law changes, concern over tariffs, interest rates, labor or workforce issues, and other. So if you could please go through and answer the polling question here. Interesting to see what some of the responses are with that. Again, for those with businesses here. Just about done with it. Okay, we closed off the poll here. Again, the top one, again, these tax changes that we're talking about today were about just about a third of those, but tariff concerns, about a quarter here. Again, that's been in the obviously in the news. And then third is the labor and workforce issues. So good. Thank you for responding on that we thought that'd be good just to kind of get a flavor for what else is affecting some of the businesses. I'd like to turn to now is, again, we've talked about, again, after Tom covered the business provisions, just some charitable provisions that are out there. Some of these are new that weren't part of the TCJA, continuing some new items here just for you to be aware of, and then we'll actually go through some planning on these a little bit too. First thing that they created is for non-itemizers, there's a $2,000 charitable deduction. Other filers get $1,000. Again, this was around during COVID. We had a smaller one, I think it was $600. But this is only for cash donation, doesn't apply to stock or donor advised funds, but you don't have to itemize your deductions to get this. So this will be available. This starts actually in 2026, so be aware of that. So if you take the standard deduction, next year, and you have some charitables, you can still be able to take those at least up to these limitations here again. And this change again is permanent. So we have that. The next one, this is where unfortunately is going to provide some complexity here. They put in a floor for charitable contributions. For individuals, it's 0.5% of their adjusted gross income. And then for corporations, it's 1% of their taxable income. A couple of highlights with it is they'll take out, again, whatever 0.5% of their AGI is, they're going to lose that. So for taxpayers, $100,000 of AGI, they're going to lose $500 of their charitable contributions. If they have $500,000, it's going to be what, 5 times at $2,500. So just be aware of that. Again, this floor, this adjustment does not apply to those who do not itemize. So that non-itemizer deduction is not affected with it. Corporations, again, it's a 1% limit on their taxable income. In some cases, that floor, that amount that you have will carry over. If you run into some of the general charitable contribution limitations, sometimes that floor amount will carry over. And just to be mindful of it, the provisions with that are much more complicated than it might first appear with it. And again, there will be some guidance on that needed from the IRS. The next one is just a reminder. We talked about this earlier, this new limitation in itemized deductions. Again, that if you're in the top 37% bracket, you only get a 35% benefit. So it's going to reduce some of the benefit of your charitable contributions. Again, the one thing with that, again, this new change for that adjustment down to 35% starts in 2026. And we'll go through an example in a minute here, is maybe making some of those charitable contributions this year in 2025 will avoid some of those adjustments. Before we go into some of the planning one, just some IRS guidance that's come out to date on this. Couple items, and this is not necessarily everything that's been out. And as Tom said, the IRS is working hard on this in their priority plan to issue guidance. 2 key items that we highlighted, I think we included in our resource materials. One is this, Tom talked about the research expenditures that changed and allow you to get the current expense and the transition with that. This RevProc 2025-28, very helpful with that, very detailed, but that provides a lot of guidance with it. And then the regulations we talked about, the no tax on tips, they have proposed regulations on that. Both of those are in there. It may be helpful to you. Again, there's a number of other items that they've issued guidance. And again, I'm sure there's much more to come, hopefully before the end of the year for a lot of businesses and individuals. I'd like to turn to now is just some individual tax strategy. We're going to go through some individual first, then some business ones. First one is, again, a couple of these limitations we just talked about actually start in 2026. The first is this 0.5% floor on charitable contributions. Again, that kicks in again in 26. Again, it's based on the AGI, not the amount of your overall contributions, but based on the AGI. And then the second one is this limitation, those in the top 37% bracket, that benefit drops down to 35%. So Next slide. I guess the first strategy or thing to think about is consider making those with charitables. Consider to accelerate to make those in 2025 rather than 2026. And here's an example. Taxpayers here have mortgage interest, charitable contributions of $30,000, state and local taxes, income is $1 million with it. Their charitable contributions are first reduced by $5,000 they lose for that 0.5% charitable floor. Then they lose 2/37 of the rest of it, another $1,300. So they lose $6,351 of their charitable contribution. So if they make those here this year, again, they're going to save $2,350 in tax by doing that. So one thing to look at is maybe accelerating those especially the top bracket, to make those before the end of the year in 25 rather than 26, and could have a savings with it. The next one to consider strategy is this concept. And again, this was available before, but I think it's sort of been accentuated, with the changes in the OB3. It's this concept of they call bunching your itemized deduction. And the idea is if you got 2 years of itemized deductions, you pay 2 of those in 1 year, and then in the subsequent year, you claim the standard deduction. So you have the same overall cash flow, you just change the timing. So in this example, we got Fred and Ethel. They have income of $300,000. They have $20,000 of state and local tax and $10,000 of charitable. They have no mortgage. Again, with the change from the OB3, the SALT limit goes from $10,000 up to $40,000. Okay, so their total itemized deductions are $30,000, but 60 over 2 years. So if they decided to bunch their itemized deductions into 2025, they would pay their taxes of 40 and their 2 years of charitable of 20 in 2025 and nothing in 2026. Okay, so the whole 60,000 happens in 25, nothing in 26. What happens if they follow this strategy? Let's go to the next slide. They go ahead with this. What we'll see is in 2025, they've got $60,000 deduction. But then that exceeds the standard deduction, so they get a $60,000 deduction. They get in year 2, they don't have any itemized deductions because again they paid them all in 25. They get the standard deduction of $31,500. So over the 2-year period, they get $91,500 of deductions between either the standard deduction or their itemized deduction in those 2 years. That's $28,500 more than if they had just took those $30,000 in each year when they were incurred. So their total cash outflow deduction of the 2 years would be $60,000, but by changing the timing, they get up with a tax savings of almost $7,000 with it. So again, that's a strategy. Again, you're not necessarily paying more than you would, you're just changing the timing with it. So that's something to look at for individuals on it.
Yeah, and I would just say this is a big deal. The charitable, the changes, these floors and these things are going to kick in 2026. If you're charitable and you have somewhat of a charitable budget for the next 5 years, you really got to look at maybe accelerating into, as we said here, or the next slide here, donor advised fund. So
Right.
Thanks for that, Jim. Go ahead.
Yeah, that's good. Thanks, Tom. And this donor advised fund again, and this is just this could work very well with the bunching strategy we talked about. A donor advised fund, again, you receive a charitable deduction when you put the money in the donor advised fund. Most of the major brokerage firms have this. You get a deduction when you fund it into the donor advised fund. Then the money can be paid out. You can direct it out of that donor advised fund to the various charities over, whatever set time period you want. It doesn't necessarily have to be the year that you contribute to it, but you can fund it in the 1 year you're bunching, pay it out of there over whatever the time period that you want. You can put cash or appreciated stocks. Again, you want to make sure it's a long-term appreciated stock, and you get a full fair market value deduction with it.
Good.
Next slide with it. Again, that works well with it, and you can check with your broker on that. And then the last one with another charitable one is we've seen more activity with it. For those that are age 70 and a half that are taking their required minimum distributions from an IRA or a retirement account, is to you what they call a qualified charitable distribution, QCD. And what they do is they direct it, so the IRA custodian pays that donation directly to the charity. that was at $100,000. It's indexed for inflation. Now it's up to $108,000 for 2025. And what happens with the tax treatment of this QCD is it's not into your income. You don't get a deduction for it. Some may think, well, maybe that's not much of a savings. You have no income, no deduction, but it doesn't go through your adjusted gross income. So you're not subject to this 2/37 adjustment. If you're in the top rate, you don't have that. So you're going to get a full benefit at the 37% rate by not including that in income. Plus, you don't have the 0.5% floor applying on that. So that's one thing to keep in mind. The other thing is for those that are, again, that are over 70 and a half are going to be on Social Security, Medicare. This does not go into their AGI, so it doesn't affect their, or has a less of effect on their IRMA adjustment that impacts their Medicare premium. So something to take a look at. This QCD is a great strategy to be aware of.
Yeah, and again, QC, I mean, the retirement accounts and charities, there's just a lot of good strategy there because retirement accounts, if we hold them at passing, they create an income tax liability to the beneficiary, and maybe that's a way. I mean, there's also some estate planning strategy. So look at the QCD though is really a great strategy for to package with charities. So look at the charitable rules here because they're changing in 26, and you will take a haircut on those charitable contributions because of some of the new rules. So there's going to be more itemizers this year, right? The SALT limitation going up. So just be aware from a record keeping standpoint that maybe now you're going to have to provide more documentation. It may matter, right? There's going to be less of us taking standard deduction. So, real estate taxes, those are deductible on personal property, vacation homes. Personal property taxes may matter again, right? Because it may actually reduce our taxable income. Sales taxes paid on large purchases. So just be aware of that. And then, if you're an owner in a flow through business and you have some of these the benefit of some of these other deductions, it may lower your income in 2025 because you're now getting bonus depreciation, or maybe your R&D flows through from prior years. So you may have a lower taxable income, and these standard deductions will matter even more. So take a look at those, and make sure that you're prepared for that. But and we're also thinking about the same thing. The other planning strategy we wanted to point out here is, again, if your income is going to be lower, there's a lot of talk about, should I convert some of my IRA to a Roth IRA? And that's really a complex decision because you're going to pay tax. But if you're going to pay tax at a lower bracket, work with your advisors and think through the pros and cons of that. But look at that. Make sure, all of us, make sure we're maximizing deferrals into our 401k and our HSA. But you really have to look at your current and future projected tax brackets to make some of these decisions. But just think about those things in the context of what the future might look like as individual taxpayers. Okay. So want to get into just a couple business planning strategies, and we're coming up on time here. We might be able to get to a couple questions. Jim, you want to talk through just the transition year? We've hit a little bit, but maybe just remind everybody.
Yeah, as Tom mentioned, thank you, Tom. And again, as he went through all these business provisions earlier, again, it's transition year with some of the different effective dates, in 2025 here. Again, you've got some significant deductions coming in. You have the bonus depreciation, as Tom talked about, coming back with it, the higher 179, the expensing of those research expenses, plus that transition amount for the prior couple of years that you had to capitalize those. You've got options on how to deduct that, and you got the interest limitations changing. So all those things playing, and again, you might do some modeling with it to say, okay, if I've got this impact, what do I do if I take bonus or don't take bonus? Or I've got how much interest am I going to be able to deduct or not? To model those out, some of those provisions, again, you might have some options and may have some benefit with it. And again, each company may be different with it, but you want to really look at, what's going to happen in 2025 and even looking ahead to 2026. Some of these deductions overlap with how the limitations apply. So again, I think anytime you have options with it, you may have some benefit, right? You're going to run the options, say what's going to be the best result for our company, not only this year, but going forward. And as Tom talked about before, the effective dates on these, CapEx items that you had for some of your purchases, watch that date, effective date, to see if you get bonus or not with it. Some of those binding contracts are going to be important, especially the larger purchases, some big equipment that you got. Check if you had a binding contract that could, not allow you to get the bonus depreciation, or maybe it does, depending on your facts. So look at those items now and use that in your year-end planning. Don't wait till you start filing the return on that. Next slide here, Tom.
Yeah, so a couple other things. We've got a couple areas where, if you sell an asset, you potentially don't have to pay tax on it, right? And what am I talking about? Well, I get, Section 1202, the qualified small business tax, qualified small business area of the tax code. So again, I think we could look at restructuring businesses if they're eligible 1202 businesses, but there's a lot to that. But just know that there are some areas where if you make an investment, there's a possibility that once you exit that investment, the gain could be excluded from tax. The other one is qualified opportunity zones, right? These are exciting provisions. They got to make sense. There's more to it than what we can cover today, but there are some interesting opportunities for taxpayers to have some gain excluded from tax. The last one we'll talk about is look at before year end. Jim mentioned the transition and some of these bonus depreciation rules and R&D and interest deductibility. Those things are all changing in 25. But we could also look at LIFO inventory for those that
Right.
May have some inflation in that inventory. It's always good to look at the impact of LIFO and maybe what that could mean for your taxable bottom line. Review your retirement plans. We run into businesses that have grown, and there's an opportunity there to really upgrade the retirement plan, allow themselves and their employees to put more money into those retirement plans on a tax deferred basis. So it's a really good thing to look at those retirement plans from time to time. And then look at other balance sheet items. There's a possibility that there could be an accounting method change that we could make that could allow
Right.
for a big deduction. So lots of opportunities there. It takes a little bit of planning, but with that, I see we're at 10:01 a.m. So I think we're going to have to call it a day, Jim, and want to thank everyone for
Thank you
your
very
time.
much.
And we will address all of the questions in the chat. Thank you for those. And please, if you have other questions, please fill out the survey and we will get to those and get back to you. So again, thank you all for attending and have a great day.
Have a great day. Thank you so much. Bye-bye.